All right, let's get right into it. If you're tuning into this explainer, you're the kind of focused learner who wants to cut straight through the noise and get to the hard facts. Today, we're unpacking a massive barrage of financial data to figure out the actual cause and effect behind today's market movements. We're not just glancing at the red and green flashes. We are digging strictly into the data to build a complete, objective picture of why the market behaved exactly the way it did today. We've got a lot of ground to cover, so let's get started. Okay, here's our roadmap for today. We'll start with the market pulse today, move into sectoral shifts, cover global markets, break down corporate earnings, check out institutional flows, and then finish up with our disclaimer and wrap. Starting off with Section 1, the market pulse today and the intraday price action. You can literally trace the market's entire psychology today just by looking at the Nifty 50's intraday volatility. We opened with a 43-point gap down at 24,050, instantly reacting to some pretty lackluster global cues and geopolitical tension. But did you notice that early strength? Within the very first hour, the index pushed higher, aiming for that 24,150 to 24,170 zone. But the momentum just couldn't hold. Right around noon, the selling pressure intensified aggressively. It acted like a magnet, pulling the index lower and ultimately dragging it below that crucial psychological 24,000 mark. It was a classic day of early hope followed by a really harsh reality check. But actually, if we look beneath the surface, we're seeing a really fascinating divergence. While the Nifty 50 closed down 0.40% at 23,995.70, giving back all those previous gains, the Midcap Select and Midcap 150 actually closed in the green. Midcaps showed some surprising resilience today, outperforming the large caps with a 0.32% gain. What does that tell us? It tells us that while the heavyweights were struggling just to keep their heads above water, buyers were still actively hunting for value in broader market pockets. Moving on to Section 2, sectoral shifts and stock movers. Minus 1.54%. That right there is the primary culprit today. Bank Nifty totally collapsed by 1.54%, tumbling all the way down to 55,400.35. When your heaviest sector acts as a lead weight, it becomes incredibly difficult for the broader market to swim upstream, This was absolutely the main anchor dragging everything down today. And the sheer contrast in sectoral performance is striking. It wasn't just a blind sell-off everywhere. Banking was absolutely the problem child. PSU banks tanked a brutal 2.15%, and auto also struggled, falling over 1%. But on the flip side, energy was the sole real bright spot today, ripping 1.22% higher. Ultimately, only 3 out of the 12 sectors managed to close in the green. It was an incredibly polarized market environment. Looking at the specific winners and losers really reinforces this polarization. The overall market breadth was decidedly weak. We saw 212 advances against 287 declines. But despite that negative breadth, this wasn't a total washout. We actually saw some rapid-fire stabilization in very specific pockets. Stocks like Cohance and Tata Chem posted massive double-digit or near double-digit gains. It just proves that even on a heavy down day, targeted momentum can still thrive if you know exactly where to look. Let's zoom out a bit. Section 3, Global Markets and our Commodities Review. So, 9,451 rupees. That is the number we need to talk about. Crude oil surged a massive 3.79% to reach 9,451 rupees per barrel. This is a sharp reversal driven entirely by tight supply and ongoing geopolitical tensions. And when oil spikes this hard and this fast, the shockwaves hit the equity markets almost instantly. And here's exactly why this matters for your charts. Expensive oil eats directly into corporate profitability. For oil marketing companies, OMCs, and heavy consumer-facing sectors, raw material and transport costs just skyrocketed. That tightly pinches their margins. It's a direct domino effect. Global geopolitical stress equals higher crude, which equals lower profit margins for domestic companies that rely heavily on fuel. You can clearly see those global ripple effects playing out across international indices, too. Just look at the Asia-Pacific region. The Nikkei slipped over 1%, falling from its recent record highs. But this wasn't just about oil. It was compounded by the Bank of Japan maintaining a hawkish stance, holding interest rates at 0.75%, which, by the way, is the highest level since 1995. This combination of high energy prices and tightening global monetary policy is creating a very volatile cocktail for equities right now. All right, Section 4, Corporate Earnings, News and Updates. The earnings data today paints a fascinating picture of two completely different economies. On one hand, you have Entern, the parent company of Zomato, reporting a staggering 346% year-over-year surge in net profit to 174 crore rupees, largely driven by massive growth in food delivery and Blinkit. On the other hand, traditional manufacturing is taking a hit. Maruti Suzuki saw profits drop 7% to 3,591 crore rupees. And why? Precisely because higher raw material costs are pressuring their margins, tying right back to that commodity surge we were just talking about. Meanwhile, big structural moves are still happening in the background, with AU Small Finance Bank applying for a universal banking license and ONGC pushing forward with a major petrochemicals joint venture. Now, beyond the raw numbers, human insights give us some crucial context, especially on days when the banking sector takes a beating. Look at this commentary from V. Vaidyanathan at IDFC First Bank. He noted that they do not intend to raise deposit rates in the near term. And, crucially, that stress in the microfinance book is now under control. This provides a really stabilizing perspective. It shows that despite the daily market noise and that massive 1.5% drop in the Bank Nifty, banking executives are actually seeing manageable internal metrics. We also got a strongly optimistic, forward-looking perspective for the IT sector from NASSCOM chairperson Shrikant Villamankani. Amidst all today's volatility, he emphasized that AI will accelerate India's tech industry rather than act as a threat, and that the sector is well-positioned to meet growing global demand. It's a vital reminder of the long-term structural growth stories that exist completely independently of these intraday index swings. Let's see how the big money reacted to all of this. Section 5. Institutional flows and market data. This comparison is honestly the defining story of our current market structure. Foreign institutional investors, or FIIs, were net sellers today, pulling 1,151 crore rupees out of the market. But look at the domestic institutional investors. DIIs aggressively stepped up, buying 4,124 crore rupees worth of equities. This massive domestic buying is effectively acting as a giant shock absorber. Without the DIIs stepping in to buy the dip, the FII selling, combined with that crude oil spike, could have dragged the market down significantly further. And the derivatives data backs up this tension perfectly. Looking at open interest, or OI, the maximum call OI is stacked up heavily at 24,500. With secondary walls at 24,000 and 24,200. This indicates some serious potential resistance overhead. On the flip side, the maximum put OI is planted solidly at 24,000, suggesting that traders view the 23,900 to 23,800 zone as the immediate floor of support. The market is essentially boxing itself in right now, just waiting for a catalyst to break these levels. Which brings us to Section 6, Disclaimer and Wrap, and our final thoughts. Let's do a rapid-fire recap of today's market pulse. Number 1, Nifty failed to hold its early gains, succumbing to a sharp midday reversal that dragged it just below the 24,000 mark. Number 2, the banking sector was the heavy anchor today, dropping 1.54% and totally stifling any broader market momentum. And number 3, that surge in global crude to 9,451 rupees is the dominant macro catalyst right now, aggressively pressuring margins and keeping volatility elevated. Before we close out, a quick but absolutely crucial note. Please remember that this explainer is strictly for educational purposes. We are analyzing data from the NSE, BSE, and MCX to help you understand market mechanics and trends. This is not financial advice, and it is absolutely not a recommendation to buy, sell, or invest in any of the securities we've mentioned. Always do your own research. We'll leave you with this final thought. You now have a clearer view of the data. From the macro pressures of global oil to the micro resilience we saw in domestic mid-caps. The pieces are all on the board. So with crude oil surging and the banking sector under such intense pressure, how are you adjusting your focus to navigate this volatility? Think about the data, apply it to your own learning, and we will catch you next time on The Explainer.